Hey everyone, Kevin here. The Federal Reserve just released their latest Beige Book. I wanted to break down some of the important things in that, and then I wanted to talk to you about what's happening, how you might be able to properly prepare yourself for kind of what's happening in the marketplace. We're gonna talk about what I've been calling the teeter-totter, but I wanna go deeper into the dumbbell analogy, and I think that's going to be a very useful one, so we'll go into that. But let's start by talking about the Fed. Here's the scoop. The Federal Reserve releases something called a Beige Book. This is what it looks like. It's literally a boring beige book that tells you what's going on, and I'm not gonna read it to you. Instead, I'm just gonna give you some of the bottom lines from it because they're very insightful so that we can understand what's going on and then how to best prepare. A lot of these things might seem self-explanatory, but I think the big thing that I took away from this at least was right here. When they talk about the overall economic activity, they usually give you a little bit of like an outlook prediction, and I like to see what the Fed thinks about this because the market looks at this. People, consumers, businesses, everybody kind of looks to see what everybody else is doing to know what we should be thinking. And that's important, especially if you own stocks or real estate. Obviously, we saw declines in travel, tourism, leisure, hospitality. This is no duh, right? And this is all from data between kind of mid-April to mid-May. Mid to late May is when they collect this data. I think they ended the data somewhere around May 18th. But anyway, the big thing that I wanted to point out here is, although many contexts expressed hope that the recovery or that economic activity would pick up as businesses reopened, here it is. Outlook remained highly uncertain, and most contexts were pessimistic about the potential pace of recovery. That's not good for them to say, right? Even though we've seen consumer confidence tick up, you kind of need everybody on the same page. In fact, there are a lot of businesses that just won't open up until they see a lot of other businesses open up and that the other businesses are actually profitable. So it's kind of like this whole chicken or egg dilemma that's happening in the marketplace. This is not very good. However, now I want to jump on over to, may this be the shortest recession ever, or is much more pain to come? And to help me kind of answer this, I wanted to refer to this because I thought this was a brilliant piece. This is actually a transcript of a TV sort of interview on CNBC with 4 different market strategists. And I'm gonna give you the bottom line on what each of them said. The first one works at JP Morgan, then we've got a guy from Chase, then we've got someone from Harvard, and then we have another person. I wanna give you an overview of what they say, and then we'll break this down and see what we can actually learn from this about the market going forward and how we might want to apply this to our investing strategies. So, the JP Morgan dude, he thinks that, hey, look, here's the thing. When you've got treasury yields so low, like bond yields are so low, it makes sense to invest in stocks even though some of them might be selling for a premium, basically. He finds, yeah, there's risk, but if you stay long on stocks, you might be more protected. But he does suggest that, look, there are problems because a lot of restaurants are only able to open at 25% capacity because of the social distancing rules. And apparently most businesses and most restaurants don't think it makes sense to open until they can get to 75% capacity. And that's gonna take a lot of social distancing relaxing to actually get to that capacity. And it makes sense because restaurants, I mean, it's hard for restaurants to eke a profit. It's a very low margin business. And I personally hate low margin businesses. I hate working in them, I hate owning them, and I hate their stocks. So restaurants are not for me. Now, moving on to what Mr. Mayo here says from Wells Fargo. He says at Wells Fargo, they've run multiple different scenarios, the V-shaped recovery, the U-shaped recovery, the L-shaped recovery. You know, we've heard of the Nike swoosh, we've heard of it all. And he says, look, here's the scoop. It's pretty tough every way you slice it, but he's actually very confident in the banks, which, in case you're thinking about investing in a stock, JP Morgan, a lot of these banks, they just had a crazy week. A lot of them are up 20% over this week, so it's kind of difficult to buy into them now. But here, he sort of defends, hey, look, banks should be able to do dividends right now because we have so much cash and we prepared for a recession like this. There's no reason we should have to cut dividends because we're prepared for this. He does go on to say that, hey, look, if there's going to be a big second wave and we go into some crazy depression-like scenario, yeah, okay, then maybe it's time for us to cut our dividends. But for right now, this analyst actually says there's no reason to kind of sap the confidence of the market, especially since so much confidence is already missing. kind of based on what we just saw in the Federal Reserve's Beige Book, that a lot of businesses and people are pessimistic about the outlook of the future, that, you know what, now is not the time to cut dividends and make it even worse, at least at the banks, and according to this person's opinion. Which, by the way, I ran a poll on Instagram and Twitter asking you about kind of your thoughts on the conditions of the market, and I would say probably like 60 to 65% of you are not that optimistic about the future. But that doesn't mean there's not an opportunity for you to make money during this kind of time. So Harvard, a Harvard University former chair of the Council of Economic Advisor, this is an economic professor at Harvard, warned investors not to get eager too soon. This is interesting. So you've got a guy at Chase that's kind of like, hey, you know what? Equities are the place to be right now if you're a long-time holder. This Wells Fargo guy goes, look, no reason to cut dividends at the banks right now if you want to invest in banks. Both of them work at banks, though. Here you got a Harvard economist saying, hey, you know what? Don't get too eager too fast. In fact, he goes on to say, look, we've already had the partial bounce back, right? We've already seen that beginning upslope of the V, he says. It's already happened. But he goes on to say the problem is you get the beginning of the V by opening up businesses, like just turning the lights back on and getting some people back to work. That's when you kind of see the beginning of the V that he calls the low-hanging fruit. Like that's the easy growth to see. It's easy to grow 10% when you're at a bottom. Well, that makes sense. He does go on to say, though, that upper part of the V, you know, if you have like the initial part of the V, that's the easy part, he's saying. It seems like he's saying, hey, you know, this next part of the V might take a lot longer. And that's kind of where you get that Nike swoosh analogy. And he says, I think you're in for a long, painful slog. So not a good thing to hear from somebody from Harvard, although this does kind of align with what the dude at Chase said, where he goes, look, if you're gonna be in stocks, and I'm gonna extend this to real estate because, well, I talk about real estate investing and stock investing in my programs linked below. Coupon code ends at the end of the month, by the way. We pushed that back a little bit. But anyway, if you're gonna be in it long, you know, now might be a good time to kind of just start buying in a little bit. And remember the strategy that we always use, or the strategy that I always recommend. The strategy is don't like blow everything. If you've got kind of a treasure chest of money where you're like, all right, Kevin, I've saved up $5,000. What do I do? Don't blow it all on one stock, and certainly don't blow it all at the same time. You know, a little bit. Every day the market's down. Every day one of your barbell stocks is red. I'll talk about that in a moment. Buy a little bit. That way you're not blowing everything. You got $5,000 to invest, put $500 in a day. Something like that, right? Spread it out. That way you're dollar cost averaging and you're not betting everything on one day. All right, what else we got? Right here, this is a big one. Keith has a big one. And when you see Keith's, well, you're gonna want life insurance because it's probably gonna stress you out. And I've got a link for you down below, right next to the link to where you could get 2 free stocks with Webull when you deposit $100. By the way, look, usually I like buying stuff with M1 Finance, but I will give a shout out to platforms like Webull and Robinhood. This morning when I saw Tesla hit $790, I quickly bought $10,000 of Tesla. It's back well over $800 now, and that little short-term opportunity. Usually on one of these monitors, usually this guy right here, I keep Webull up and I kind of track what stocks are doing. And when I see all of these sudden dips, sometimes they only last for 30 minutes to 60 minutes, I like to kind of buy. So at the very least, you know, throw your $100 in and then maybe keep that chart open and go, all right. When's Tesla dropping under 800? We'll talk about stocks in the barbell in just a moment though. Let's go ahead and look at Keith's argument here. He is a chief market strategist at SunTrust Advisory Services, Truett. This is what he believes. He believes that this could potentially, or wonders, is this going to be the sharpest and shortest recession in history? He goes on to say, look, if you go back and you kind of look at history, you see that usually the difference, or like the market tends to bottom out about 4 to 5 months before the recession is over. And so in his opinion, we've already seen the bottom, and they thought the market was going to stabilize in summer, but it's actually already starting to stabilize. So he's making this argument that, hey, you know, this could just be the craziest short-term blip. Now, I don't know if a lot of us can relate to that because a lot of us are like, you know, as individuals, we're not doing as well. And I think as individuals, we believe more in what the Fed says when they say, look, people are highly uncertain. There's a lot of uncertainty. There's almost radical uncertainty in terms of, is there going to be a second wave? Is there not? How's the reopening going to go? Are we going to see spikes? How bad are those spikes going to be? If we send our children to preschool, are they all going to get sick? And are they going to have long-lasting health implications because of that? In fact, one of the things they mention here is a big problem is limited access to childcare. And I get that because it's like, oh, do I send my children to school to bring stuff back home? I don't know. It's weird. Children aren't really good at social distancing. They're not really good at washing their hands. And I'll tell you, there's no way Jack or Max are wearing a mask. By the way, Lauren did a new vlog. So if you want to see a little bit of myself, Lauren, Jack, and Max, make sure to click the link down below next to Life Insurance, My Program, and Webull, and you'll see the little vlog link. There you could see Lauren, myself, and the kids in a little bit of a family vlog, and it gives you some real estate and property management advice as well. Now, continuing on here, what about this sort of barbell that I'm talking about? All right, let's explain that, and I think this will give you a little bit more insight. So I've always been referring to this as sort of the teeter-totter market, where on one hand, we've got stocks like Beyond Meat, DocuSign, Peloton, Facebook, Zoom, even Walmart, Costco, PayPal, AMD, Nvidia, Amazon, right? These companies are kind of like all on one side of the teeter-totter. Now, on the other side, you've got all of the other companies, which are like Macy's, Dave & Buster's, Carnival, Delta, Cheesecake Factory, Norwegian Cruise Lines, AMC, Cinemark, the Simon Property Group, right? And it seems like every day we kind of have this teeter-totter going on. Well, I like this new analogy better. It's actually the barbell or dumbbell analogy. Kind of think about it like working out, and it's kind of like you're lifting the economy up, and it's like, oh, this side's getting heavy. Oh, this side's getting heavy. I like that analogy. Like, it seems to make a lot of sense. And what I would recommend to you is, if you're thinking about investing in stocks, because, look, when I invest in real estate and I buy real estate below market value, well below market value, that's the only way I buy real estate. Otherwise, why deal with real estate? Just sit here and invest in stocks. But if I could buy real estate 100 grand, 150 grand below market value, my net worth instantly goes up by $80,000 to $120,000 when I buy a deal, even if I'm buying it with like 3% down. Why would I not do that? That's the stuff we talk about in the program, right? Taking advantage of the federal programs that exist that allow you to do this. That's why you can build your wealth so much faster with real estate. But much like being conservative in real estate and buying properties well below market value, I like to be conservative in stocks. And so if I've got, this dumbbell thing going on, I'm not gonna blow everything on one side. It's not like I'm gonna go to the gym and put, 35 pounds on one side and 0 pounds on the other, because it's like, dink, that's not good. And I know I'm using a small weight on purpose, okay? Because you don't wanna go crazy heavy right now, because, I'm not gonna blow everything on stocks. You wanna be diversified between real estate and stocks. But say you go in slowly, right? You add 5 pounds at a time is almost the way to think about it. But you don't want to add them all to one side. So think, if you got 35 pounds to play with, put, 10 over on one side of the barbell, right? On a red day. So today's, in my opinion, a day, and I executed trades on companies like Peloton or Amazon or Tesla. Those were sort of on that one side of the barbell. And then on the other side, if we see the banks pull back and we see the airlines pull back, and we see the entertainment stocks and the Dave & Buster's and the restaurants pull back again, then maybe it's time to add a little bit to that side. But again, don't go heavy. Don't put all your weights on at once and then you're too heavy on one side, too heavy on the other side. I don't know. I like that analogy, but I want to hear what your thoughts are, especially since we had some insight here from the Fed showing how pessimistic everybody is. But that pessimism is exactly what's fueling this. If everybody was optimistic, you wouldn't have this shakiness. If you're optimistic, you go in there, you pick up the thing, and it's like, all right, we're going up today or we're going down today. We're going up today or we're going down today. It's kind of everybody's feeling like, oh man, I don't know. That's a lot of weight on that. Oh, I'm losing it. Oh, overcompensated, right? And that's kind of almost what you want to be taking advantage of right now if you're thinking about getting into the market. Obviously, an easy way to do that is you can use Webull, lets you trade before hours and after hours. If you prefer to use Robinhood, that makes it easy. Heck, you could use the Cash App. I don't even really care what you invest in, but if you're very uncomfortable about this whole barbell thing, then buy the gym and buy VOO, right? The Vanguard Total Stock Market Index Fund, the S&P 500 kind of mirroring index fund, which just buys you kind of a little bit of everything. You bought the gym, right? If you want to be more aggressive and you want to pick, make sure you're not dumping it all on one side, and understand that we're having this right now. So don't panic if one side is going down after you bought, and you're not a hero and professional investor if your other side, is going up, right? It just means you're on the ride. But the last thing you want to do is be the dude sitting on the bench watching everybody go, ha, look at them struggle picking up the weights. You're atrophying if you're on the sidelines, in my opinion. I don't think the barbell's going away. I believe in the barbell or dumbbell, whatever you want to call it, long run. But don't stay on the sidelines. Get in a little bit, get up, put some weights on the bar, get started. And if you need help, check out those programs down below. I go live to help you out personally every day the market is open at 9 a.m. Thank you so much for watching. Check out Lauren's vlog next. She would totally appreciate your support, and she's got some great insights as well. I recommend you leave her a comment and ask her what kind of, or tell her, hey, I'd love it if you talked about this. If you want Lauren to talk about, hey, here are my opinions on the stimulus, here are my opinions on this, here are my opinions on politics or whatever, tell her that. Go motivate her. Thank you so much for watching, folks, and we'll see you next time.